Hello, Todd Long, myrealestateagentcoach.com. Today I wanted to talk to you about where the market currently stands and what trends we're seeing for the future. And here we are at the end of March 2015. A few of these slides that I'm going to show you today are from the Gary Keller vision speech at the Keller Williams Family Reunion that happened in February. And then we're going to take a little bit more hyper-local look at the Charlotte regional market. So it's really important to realize that the national numbers and the national trends are very important, but real estate is local. So I'm going to show you the Charlotte trends, but real estate even gets more local than that, down to the neighborhood level. And that's really where you would want to talk to a real estate professional in your area. I strongly suggest that you talk to a Keller Williams agent in order to get the true market trends that are going on in your area. So let's take a look first at the home price annual appreciation. You notice how we were on this trend line for such a long time of nice steady appreciation, and then 2002, 3, 4 we started breaking through that trend line and overextending ourselves. And anytime you see that happen, or most of the time, you can expect a downturn, which is exactly what we saw. Now, what often happens is you get back to this trend line, but we have not done that, and it seems like we are establishing a new trend line here, about 17% below the original trend line. But what is most interesting about this graph, in my opinion, is we are only what's that? Is that 14,000 or so below the peak back in 2006. So basically by 2016, we really should be back at the peak for annual house appreciation. I remember, in 07, 08, 2009, people were saying, oh, that was the good old days back in 2005 and 6. We'll never see those numbers again. Well, we're getting ready to see those numbers again in 2016. The next thing I wanted to show you is our annual appreciation over time. Back here we were on a track of about 3.39% appreciation over time. Then 2001, 2006, we kind of overextended ourselves when we were looking at about 8.9% appreciation over time. And we had that big correction, and we were down negative 4.6% from 2007 to 2011. But we should see, on average, nationally, a 5 to 6% appreciation over the next several years. And that's very healthy. We can sustain that. Now, we did have this big bump up here in 2013, and I really feel like that came from, there was a lot of investor money that came into the market, the Blackstones, the America's Home for Rent. There was a lot of hedge fund investor money that came into the market and bought up inventory. And that really pushed the market higher because the first-time home buyers and the people that were going to move into homes really didn't have a lot of inventory to look at. And they had to bid close to asking price to beat out these cash buyers that were in the market with hedge fund money. So we saw appreciation here that was probably not healthy and not typical for the market. Those big investors are not in the market as much now, and we're seeing that 5.8% appreciation right now, which is much more healthy and sustainable. Next thing I wanted to show you is the affordability index. Historically, families in America have spent about 21.6% of their total household income on housing. From 2013, we were at 14.2%, 2014, 15%. So we still have a good bit of room to grow this market from an appreciation standpoint and still be back to the historic average of the amount of money people are putting towards the home purchase. This is probably one of the most important graphs that I could show you today, and this is the affordability in perspective. This is something that Gary Keller showed us at the family reunion, and I really felt like this was something we should be sharing with all buyers and sellers in this market for that matter. So if we look back at 1989 The median home price was $94,000. Today, that would be $179,000. Mortgage interest rates were at 10%. Their monthly principal and interest payment was $825. Today, that would be $1,574, just adjusted for inflation. And then the median income was $28,000, or adjusted for inflation, about $54,000. So payment of $825, income $28,000 would buy you this house. Now we look at the house in 2014. The median home price is $208, but the interest rates are super low at 4%, which means the monthly principal and interest is $995. Not that far from the PMI back in 1989. Certainly better than the adjusted price. And the median income is $52,000. So affordability-wise, houses are in great shape right now. If it was ever a time to buy with the interest rates this low and be able to get into a home with a principal and interest of $995 for about a $208,000 purchase, really, really good news for our real estate. This is also a very interesting graph, and I'm going to just pan this over for you a little bit more. There we go. This is a very interesting graph because this is the distressed sales from 2008 to 2014. Now look at this peak that we had. We were at 34, 49, 38% of all home sales were distressed properties, either a foreclosure or a short sale, in 2008, 2009, 2010. So nearly 50% of the market was underwater, either a short sale or a foreclosed home. And that, I heard back then people were saying, oh, these banks have all this inventory. They're going to flood the market with inventory. The banks don't want to flood the market with inventory. They want the market to be healthy. They want house prices to increase, not decrease. When you flood the market with inventory, you're going to see prices go down. Banks want prices to go up because more people can buy homes. They get to make bigger loans. They make more money on them. So they had no intention of flooding the market with inventory. And this is proving this fact that over time, they have slowly released their inventory into the market to the point now we're down to 9% of the home sales are distressed, either a short sale or a foreclosure. Folks, this 9%, that is nearly no foreclosure and short sale inventory. And I think we're going to see that that's going to really allow appreciation to happen in this market. It's also going to allow normal home sellers to get into this market and sell their home and buy the home that they want to move into, because there just isn't that low end, under market valued properties. These banks, whenever they put a property on the market, they usually put it on the market under fair market value, because they are not in the property ownership business. They are in the lending business. When they own a property, they must sell that property into the market. And the way they do that is they sell it into the market at a discounted rate most often, so that they can get rid of it, get their money back, and be able to go out and loan some more money. That's how they make money, is lending money. They don't make money by holding on to property for the best value. So here we are at 9% of the market is now short sale inventory. And I'll slide this over just a little bit more so you can see that. So 9% of the market is short sale and foreclosure. All right, so the next thing I want to show you is the new home construction. And new home construction, I learned back from Lawrence Yun, who is the chief economist for NAR, back in 2009 or 10, he came out and was talking about the new construction inventory. And I don't know if it was Lawrence Yun or someone else, but they made a very good point that we have 3 million new babies born into America, new people that come into America net every single year. So you take the people that pass away and the people that are new into America, and we have about 3 million per year net positive. Well, if 3 million people net are coming in, they grow up, They go through school, they get into college, they go through college, they get a job, they get married, and those two people typically buy a house. So not all of them buy, some of them rent, but a lot of times they buy a home. That means we can support about 1.2 million in new construction every single year because 3 million people get married, 1.2 million, some of them rent, most of them buy. 1.2 million homes per year we can support as new inventory. Because remember, resale inventory does not create new inventory. Somebody must move out of a house, move into another house in order for a house to become vacant. So there's always just turning over in resale market. There is no new inventory in the resale market. It only comes from the new construction market. So we can support about 1.2 million homes per year. So here we are back here at the historic average of 1.0 million homes per year. And we started coming down in 07, and then look at 08, 9, 10, 11, 12, 13, 14. We have been well under that historic average for 7 years now. We have a lot of room to make up in new construction. So what I'm going to be watching to see is, when do we actually cross over that 1.2 million in new home construction, which we were way over that in 03, 04, 05, 06, 07. We were over that 1.2 million, which meant we had too much inventory, too much supply, not enough demand, crashed the housing market. One of the causes of the crash of the housing market. But this is the indicator I'm really going to watch, is how many new home construction starts do we have in the country. And when I start to see it get back to this historic average and get close to that 1.2 million, I don't know about you, but I have investment properties and I will be selling them all when I see that happen again. All right, next thing I want to start showing you is some local statistics, and we'll just start with that first-time home buyer market. And I'm going to look at the price between $100,000 and $250,000, and we're looking at Charlotte. So city of Charlotte, all of the city of Charlotte. I'm looking back at a 3-year graph, and we're looking at all residential types. And you can see here, I hope you can see here, there's 14.7 less homes per sale trending over time, over these 3 years. And we're up, I think that says 61%. Let me zoom in a little bit here and make sure we got this correct. Okay, it's actually 81% of the market. We are up 81% in sold inventory from the beginning of the time to the end. So we're down on inventory available, we're up on sold. So supply, demand. Supply is down, demand is up. Let's look at this a little bit more closely in a month supply of inventory graph, which is right here. And this is looking at over the same time period, 2012 to 2015, right at the beginning. And we were at 11 months of inventory at the beginning in this price point between $100,000 and $250,000. That's kind of the first time home buyer market. 11 months of inventory. So we have to remember that a balanced market is between 5 and 7 months of inventory. Anytime we're over 7 months of inventory, we've moved into a buyer's market. Buyers control the market. There's a lot of inventory. They can go out and bid low on properties. If you don't like my offer, I'll go find somebody else that does like my offer. Then as we trend down, when we get below 5 months of inventory, we move into a seller's market. Now there's more buyers in the market than there are sellers. Sellers are in a little bit more control in the market. If they price a property correctly in the market, not above fair market value, but at a fair price, they often get multiple offers on their property the closer we get to zero. Now, you can never get to zero in a month's supply of inventory. There will always be some inventory available in the market. What this is telling us is, if we were to sell the same number of properties every single month, the same number of buyers came into the market, and no sellers came into the market, we would be completely out of inventory in 4 months. Well, we know there's always going to be sellers coming into the market, and there's always going to be buyers in the market. So that's why 5 to 7 months is a balanced market. Everybody's treated fairly. Anytime we get below that, the sellers are in control, and you can see that trend line is still trending down. We still are a lack of inventory in this market, which again to me indicates we probably need to have some new construction in this market. So just to prove that this isn't an anomaly just in that first-time home buyer market, I want to also show you the 250 to 500 price point. Again, this is the supply and demand, 17% lower, 109% higher in sold volume. So we're down in inventory. I'm sorry, slightly up in inventory, way up in sold inventory in this 250,000 price point in Charlotte. A little bit easier to see on the month supply of inventory graph, which is here. Again, we're looking at the 250 to the 500. Look at that, almost 12 months of inventory in 2012. By the beginning of 2013, we were at a balanced market. And by the beginning of 2014, we were into a seller's market. And I will tell you, there are parts of our market that this is 2 and 3 months of inventory, not 4 months of inventory. So again, the real estate market is very local, but this shows you right here what a dramatic change we've had over the last couple of years in the supply of inventory. The last thing I wanted to show you is a percentage of original price to the percentage of list price to close price. So what a property was on the market for and what it actually sold for. So back in 05, 06, 07, when the market was super hot, overheated hot, people were getting about 98 to 99% of list price. It meant it was a bidding war. Buyers were willing to pay top dollar for a property. If it came on the market, it was a fair price. There were multiple offers because there just wasn't enough inventory available. And then the crash happened. And then we were getting 96% of list price, 95% of list price, 94%. This little bump right here, very interesting in the market almost nationally. What happened here is this was the government trying to stimulate the real estate market, because they know if the real estate market is strong, most of the rest of the market is strong. And they gave a tax credit right here. But you just cannot force the market. The market is going to dictate where the prices go. The market dictates the price. You cannot force it. The government tried to, but you see what happened. We came up a little bit and then we had a bigger crash. But finally we saw a bottom in the market in the end of 2011. People were getting 93% of list price, but all of a sudden this climb just started happening. And so far we've gotten up to about 96, 97% of list price. I think we're probably going to see that trend a little bit higher, but we really don't want to see it get back to 98, 99% of list price, because that really means the market is too tight. Appreciation happens too fast. It is unsustainable, and we will have another crash. I hope this helps. If you would like to have any of these slides, you can certainly reach out to me and I will get them to you. But for now, signing off.